US small cap equities are at a critical juncture. Not only has the valuation gap between small and large cap stocks grown exponentially wide by historical measures, but also numerous small cap macro tailwinds appear to be gathering force. Small caps also span a vast range of characteristics and performance drivers that even seasoned investors may not fully appreciate. So how can experienced managers have the potential to exploit them in the new year? My name is Anu Rajakumar, and I'm thrilled to welcome Greg Spiegel, portfolio manager on our small cap team, to delve into the intriguing landscape of small and mid-cap investing and why he believes these areas can offer attractive opportunities in the current market environment. Greg, welcome to the show.
Thank you. Thanks for having me.
Now, I know it's been a busy few months for you and your colleagues managing small cap, so let's start with a bit of reflection. Greg, what's been driving the recent interest in the small and mid-cap investment space?
Sure. If we take a step back, we have gone through an extended period of underperformance for small relative to large, which has led to a valuation discount approaching sort of historic levels, between 25 and 30% discount to large, depending on how you measure that. It's our view that the entirety of that underperformance has been driven by multiple compression as opposed to earnings growth, because small cap earnings have actually been quite good. And so in our mind, it's really investor skepticism around the sustainability of that earnings and cash flow stream. So if we have a period of underperformance, which has led to a discounted valuation, supported by some potential tailwinds that we think are emerging, sets the asset class up, I think, quite well.
All right, terrific. You know, some of the trends that appear to be affecting small caps are reshoring and globalization. So could you expand on that a bit, given there's been a major realignment in global supply chain that has probably affected the space quite significantly?
Sure. COVID really highlighted the risk in having very distant supply chains for critical materials, whether it's part of the semiconductor manufacturing supply chain or pharmaceutical supply chain. And what we've seen and observed from our companies is a reshoring or a friendshoring, where supply chains are moving back closer to the U.S., whether it's U.S., Mexico, or Canada. We've also started to see what we're calling the reindustrialization of the U.S., where manufacturing itself is being brought back into the U.S., primarily in the middle of the country. And so what this does is this creates a tremendous amount of economic activity, and that economic activity tends to disproportionately benefit small companies because they generate over 80% of their revenue inside of the U.S. And so as we think about the backdrop for earnings and cash flow and returns over the next several years, this activity provides a very attractive secular tailwind, I think, again, for many years to come.
Yeah, totally. And in addition to that, as you'll probably agree, we have an interesting and evolving macroeconomic landscape ahead in 2025, between former President Trump heading back into the White House, interest rate cuts, potential for regulatory and tax changes. So, Greg, what role do you see macro policies playing in the success of small and mid caps?
I think it's quite important, and it's our view that the new administration is pro-business, pro-growth, and pro-U.S. So rolling back the regulatory regime, allowing the permitting process across sectors to be more seamless and shorter in time, will give CEOs confidence to make the capital allocation decisions around where to build a facility, where to expand capacity. And with that confidence, again, comes a lot of economic activity, and it really ushers in sort of animal spirits. And with that, a lot of business optimism, which tends to really be one of the main drivers of small cap revenue and cash flow. And so, we think that coupled with the underperformance, the valuation discount, the reshoring, reindustrialization of our country, and the release of these animal spirits, again, really creates an attractive setup for the asset class.
Yep, sure. And what about taxpayer status as well? Is that another component of that too?
Yes. Well, small companies tend to be full cash taxpayers because they're all headquartered in the U.S. They can't move their headquarters to low tax jurisdictions. They can't take advantage of the arbitrage by having significant amount of foreign earnings. And so corporate tax reform, again, is quite powerful for small companies.
Absolutely. I do want to talk about the case for active management within small caps. I want to note that the small cap index has seen an increase in its exposure to lower quality companies, which has increased over time. Would love for you to just affirm if that's true and maybe explain why that matters when considering the implementation of small caps, whether that's through active management or passive.
Sure. So yes, indeed, that is true. At our last check, 45% of the companies in the index lose money on a GAAP basis. So they just report losses. Now, if we look back over the past 10 or 12 years, that number has structurally increased. And really what happens is, as the discount rate was zero, that invited a tremendous amount of speculation into the markets. That speculation manifests itself inside of the Russell 2000 index. The price of inclusion, if you will, is to be born and to be small. You don't have to make money. You don't have to have a net worth. And so we're left with a significant overhang of zombie companies and companies that don't make any money. In addition, when you have companies that don't make money, they have to borrow to fund their operations. And so the leverage at the index level is about 4 turns of debt to EBITDA, and it's all floating rate. And so you have a combination of a lot of money losers, very high leverage, and extremely low returns, which makes the index extremely risky and very low quality relative to, let's say, an S&P 500, for example.
Yeah, sure. And speaking of S&P 500s, maybe also let's talk about valuation for a second. We obviously have the mega caps and their ultra high valuation, but maybe speak about the valuation gap, right? You mentioned it's historic levels. Talk about that, how it presents opportunities, and whether that also presents any challenges for you as a portfolio manager.
Yeah, so it sets up an attractive opportunity because, again, the earnings have been pretty good coming out of small companies. It's been the multiple that investors have been willing to pay. And so if we think about all the items we just noted, they're all very supportive of continued earnings and cash flow growth. So the ability to pay less for more over time, I think, is what helps to create attractive returns. The concentration risk also in the index is top of mind for investors. So to have the diversification outside of those 5, 6, or 7 names, I think is hugely important. And so the valuation argument sets up one of many inputs into the case for small.
Yep, sure. So Greg, we've spoken a lot about the tailwinds for small cap, but conversely, tell us about some of the biggest risks that you see for small cap equities.
Sure. So I would say first is more of the same. So continued concentration into the mega cap companies, continued domination by large mega cap S&P 500 is a risk, even though the ingredients are all in place for an attractive setup. The second risk is where we are in the business cycle. And if investors think that we are potentially heading into a slowdown/recession, small caps tend to be deemed quite cyclical in nature. And so those usually will lead us into a recession and will also lead us out of a recession. So that's something to be aware of as well.
Terrific. Well, maybe, Greg, now wrapping all of this up together from what you've said today, how should investors position themselves to take advantage of these dynamics within small caps going forward?
We strongly believe active management is the way to have exposure to the small cap asset class. As we discussed, the index is quite risky. It's filled with a lot of companies that lose money, has a lot of leverage. Active managers tend to focus on businesses that generate a lot of cash flow, have good balance sheets, very high returns. So I would suggest active, and I would suggest staying very high in the quality spectrum, especially in light of where we think interest rates will stay, as well as inflation.
Great. Well, thank you very much for sharing those thoughts, Greg. Before you go, I have to ask you a quick bonus question, which has nothing to do with what we just spoke about. So my question for you is, what's on your personal bucket list? Something that you would like to do or see or accomplish within your lifetime?
I'd like to ski 100 days.
100 consecutively?
100 days in a ski season.
And where would you like to do that in
Wherever.
the world? Do you have a favorite mountain or place in the world you like to ski?
We ski a lot in Colorado, but I'm open.
Like if I need to go to Japan, I will go to Japan
Sure.
or the Alps, wherever it may be.
Sure.
Great. Well, Greg, thank you so much for all of your thoughts today. We covered a lot of ground. When it comes to small caps, you spoke about the valuation gap between small cap and mega cap being at historic levels. And we talked about the reindustrialization, the potential for economic activity to pick up in 2025, rolling back a regulatory regime, corporate tax reform, all being some of the factors that we think will be tailwinds for small caps. But I also appreciate your comments highlighting some of the risks to that view, namely that the mega caps may continue to be magnificent and continue to be on this incredible rally. And also, understanding where we are in the business cycle. As you said, for small caps, early business cycle and early cutting cycle typically is good for small caps, but obviously there's risk in that view as well. But ultimately, the key messages here that you shared: active management, high up on quality, strong cash flows, good balance sheets, all make for a good recipe for small cap investing. So Greg, for all of those thoughts and more, appreciate you coming on the show today. Thank you for being here.
Thank you for having me.
And to our listeners, if you've enjoyed what you've heard today on Disruptive Forces, you can subscribe to the show from wherever you listen to your podcasts, or you can visit our website at nb.com/disruptiveforces, where you can find previous episodes as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.